Good afternoon, everybody. This is Kim Arthur, the CEO and CIO of Main Management, and I'm joined with my VP of Research, James Maxwell. We want to talk about the macro outlook for 2025 first quarter. What are you thinking, James?
Well, it's certainly been an interesting year. 2024 wrapped up. We're in the middle of almost the end of January now. I think 2023, 2024 everyone was fairly consensus coming out of that bear market. We're in the third year of the bull market now, and it's a little less certain of what will happen, what's going on across the economy and markets as well.
Boy, isn't that true? The start of 2024, there was still, as you mentioned, that recession linger fear, and the GDP consensus from the Smart Street strategist was +1. Looks like it's going to come in at +2.7. So this year, they're like, oh, don't burn me twice here. So the bogey's been moved up to +2. But do you think there's upside in that +2?
I think there is. There feels like there's things out there, whether it's productivity, AI, just overall how the consumer is doing, that makes it so there's upside in that GDP number. And as a result, markets also, I think, have upside. There's uncertainty as well. We'll get to that. But I think it's shaping up to be a good year overall.
Love it. All right. Well, let's not keep our audience waiting here. Let's jump into the slide pack here and try to put some meat on the bones of the slide pack, so to speak. So this is a picture of our product introductions and our AUM growth. The one thing I look at there is we started at 25 million. We're at 3.8 billion. Thank you, clients, for your partnership. That's probably a 23+% CAGR growth. So we couldn't do it without the clients. How about the next one? That's the team, the 5 IC members that basically were working for James and his research crew. So James, thank you for all that you provide with the data packs and all the insights. So we could not do it without you. Looking into, these are, 4 quick statements, and then we'll get into the meat of this. But again, it's costs, it's trust, it's price and proof, and it's time in the market. So those are timely pieces. And every day, I know James and his group and the whole firm, we lead from the front there.
I mean, this is why we have it in here as a reminder every time we look at this for kind of things to live by.
Yep, exactly. All right. So got a question for you, James.
Yep.
King SPX at the top of the charts again.
Yep.
And fixed income at the bottom.
Yeah.
Do you think fixed income with the brackets around it, only the 10-year this year or last year, what do you kind of see for fixed income going?
Yeah, I mean, it's faced a few tumultuous years, 2022 especially. I think had a lot of people realize that there are risks in fixed income, especially in the longer end of the curve. And to be honest, I think turned a lot of people off from the asset class entirely. We don't think it's an asset class that you have to avoid. I think there is a place for it in a portfolio. There certainly are still risks that are out there. And in terms of our outlook, we're not exceedingly bullish or bearish either way. I think kind of as a base case, looking at the coupon, 4.5%, like a rough estimate of what you can expect over any 1-year time frame. So that's kind of our base case. So yeah, I mean, it's not something that's going to blow up 30% in a year like the S&P, but it ultimately serves a point in a broader asset allocation.
And it's interesting, the 4.5% coupon, that's historically what fixed income has. Your forward returns are your coupon. So you're saying we're basically going to get back to where we were historically.
Yeah, I think that's we're in a normalized environment. Rates aren't at zero anymore. It's not that kind of pandemic period. You're kind of chugging along with the economy. I think there's no reason that it shouldn't just be the historical kind of average.
Makes sense. All right, this next one here, we look more at the sector level. And question for you, if you look at communications and IT, so the 2 at the top of the stack, equal weighted, they were up about 38 points. And then your bottom 3, real estate, healthcare, and materials, they were up about a little less than 3 on an equal weight basis. So a 35-point delta in favor of the top 2. I've noticed year to date, that's turned in favor of the bottom.
Mm-hmm.
The bottom three have about a 2-point advantage. So are they going to close down that extra 33 points?
I think the issue is that's where you're getting the growth is those communication services, infotech, the other areas of the market. There is growth, but it's just hard to surprise to the upside, especially in an industry like utilities or healthcare where it's so regulated. These companies can only make so much money every year. It's hard to even surprise to the upside, beat expectations to where the price goes up. I think there's the past couple of years, I mean, tech has been dominant. Mag 7, you've seen this kind of, call it bifurcation of the returns between these Mag 7 and broader tech companies with, the other sectors like healthcare, materials, et cetera. Will that continue? It's unclear, of course. I think a lot of that Mag 7 doing well over the past 2 years was it drew down a lot in 2022. They got really, really cheap just looking at multiples. They were like 15 times for these world-class companies.
Right.
And I think the market realized, okay, not only are these companies worth more than that, there's also all these tailwinds, AI, et cetera, that they kind of got repriced back to probably where they should be or closer to where they should be. So on a forward-looking basis, it's like now you have these dominant players making up 30+%. Where are the opportunities? There's probably some outside of the Mag 7. We like some areas outside of the Mag 7, especially on like mid or small cap, some growth there that you didn't see in 23 or 24 in earnings and in revenues. And then also in sectors, just looking at this chart, healthcare, it seems like a solid industry. It has some regulation headwinds, but overall, it could act as a good kind of barbell with the higher flyers, the tech companies with healthcare being more defensive, less of the value based on kind of future projections, more of it based on today's earnings.
Yeah. Well, and to your point also, you mentioned healthcare with regulation. If you look at inflation cost curves there, healthcare loaded with it. If you look at basic materials, you want to be a consumer of those because they're always in a price decline.
Yeah.
They're always deflationary. And so that's because you can always produce more commodities and get more efficient at it. But to your point about the top guys, comm, services, and IT, they face the market and they better be competitive. And lo and behold, they're both deflationary things because they're constantly lowering prices and giving you more.
Yeah, it's Moore's law. It's any sort of technology advancement. Prices get lower, it's better for the end consumer. So they have to be very, very competitive with that because, they have a high margin one day, the next day that can disappear.
Yeah. Okay, let's take a look at the next one here, which I think is the picture of what's supposed to happen in the first year of an election cycle. But you've taken this and you've funneled it down even further in a bull market, which we firmly believe that we are in a bull market. So if I'm just kind of eyeballing that, it looks like your first quarter's up a couple of points. Your second quarter looks like you're up 4+. Third quarter kind of takes a little dirt nap, timeout with traditional summer, August, September kind of pullback, and then you surge through the close. I like it how you made this so that it exactly matches our price target of 6,600, which is up 12%. So good job on that's why you guys are in the research. So also maybe just let our audience know that as goes January, goes the year. I do believe right now through this recording, January is up about 3% on the month. So give us a little bit of flavor about that.
Yeah, I mean, this election cycle chart is something we look at as a kind of a guidepost for broader market returns. The philosophy behind it is as a new president comes in every 4 years, or a president term comes in every 4 years, they often can drive some of the market movement by announcing new mandates or appointments or et cetera. You can see that in that January, that first month, pretty strong. And we've seen that so far in this January. As you mentioned, February, March kind of stalls out. It's hard to get a ton of information from something like this. There's obviously a lot of noise every year, but as a broad kind of, goalpost or indicator. It tells you that it's going to be a strong year if you look at just this one data point.
Yeah.
There's some, if you look again in August and September, there's maybe some weakness. Obviously, we'll see in 7 months if that's the case. Yeah, it's something we look at as kind of a spot check.
Yeah, it's interesting. The picture you had for last year, the fourth year of the presidential cycle in a bull market, it was spot on. The order of magnitude was much higher than what was predicted, but the shape of the curve was exactly the same. So, all right, let's flip to the next one here. This is your bull market trajectory. So as I look through this, essentially, if you kind of add up all the numbers on here, and I know we've got the next slide that goes more into details, but this is a little bit of a tamer year, but you can still see these are positive returns. And maybe flip to the next one because I think that kind of really talks about it. Yeah, this picture I think is interesting. As you look at this here, 28 months into a median of 55 means that we're in the top of the fourth inning on time. Now, I'm not a ball stick guy, so I'm assuming you're right on those innings. Put me on water and I can do a little bit better. On a price basis, 69 out of 121 means we're probably in the top of the fifth.
Yeah.
But I would bet that a lot of people think that we are closer to the end than in those innings there. So maybe talk a little bit about that.
Yeah, I think one of the things that we looked at, and you can see it really visually here, is there's some periods that last a very, very long time. And then there's some bull markets that only are like a couple of years. So, that 1990 to 2000 was 150 months and you had 839% cumulative return. And there's a lot of parallels between kind of today and that late 90s, mid 90s period. So we see that as a potential parallel in terms of broader market returns. Obviously, we don't know what will happen in 2 years, 3 years. There's black swans, unpredictable events that can happen and wipe out a bull market like a COVID or anything else. In terms of, I think this chart shows kind of that the returns so far, or how much attention they've gotten. Mag 7, S&P up, double digits twice in a row, or 20+% twice in a row. It's not that out of the ordinary.
Yeah.
When you're coming out of a bear market, there's a lot of upside to capture. So I think this does a good job of showing that.
I think it does a great job. And I think to your point, the 1990s with that huge bull market, like you said, it was a technology-driven market. It was also a labor shortage, so you needed productivity, which I know we're going to get into productivity a little bit later here. And so there are definitely parallels. And I always like to look at the piece there. It was technology-driven with 30 million people starting from zero that joined the internet. But today, we have 5 billion, that's with a B, that have joined the internet. So you still got 3 billion more to get on it. And you have 7 billion smartphone devices there. So big install base. All right, let's see what we got on the next one here. All right, I'll let you dig into that. I'll just make a quick comment on this where I like to look at the 2-year as my real guidepost. It's a very big liquid market with a lot of players. And what it's supposed to tell you is what the chances of rate cut, what the rates are going to be in the forward 12 months. And right now it's telling you with a 2-year at 4.23, basically says that you have about 12 basis points of cuts in the Fed funds futures. Not a lot. And the Fed funds futures are probably down to like 1 cut now. But as you point out here, it was a hell of a lot higher 4 months ago.
Yeah, so this chart's really looking at what happened in the last quarter of the year. I think a lot of movement on the outlook for sure. And this kind of distills the story. So kind of how to interpret this chart, obviously the dark blue line is what the Fed has done over the past couple of years. The dashed blue line is expectations of what they'll do going forward. That was as of the end of the year, so 12/31. And you can see it's only 1 to 2 cuts expected during 2025.
Yep.
That green line was what the Fed was expected to do as of the end of Q3.
Wow.
Looking at the next, 2025 as of the end of September, everyone thought, or the market thought, that the Fed was going to be much more aggressive. They were saying 5 to 6 cuts during 2025. And I think the Fed came in to Q4 and pulled in a lot of those expectations along with the market and how the economy was doing overall. But I want to say most of that was actually the Fed commentary, Fed speak that came out, and people realized, okay, maybe we don't need to expect as many cuts next year.
Yep.
That's not necessarily a bad thing.
Yeah.
But it's something to watch for sure. The Fed drives a lot of the market.
Yep.
So that's something that we wanted to point out as a big mover the past few months.
Yeah. So if you flip to the next one, obviously, Fed has a meeting today and tomorrow. So tomorrow they'll make the presser. So we'll get to find out what's in Powell's head.
Yep.
And there will not be the summary of economic projections since those are on a quarterly basis. We had that in December. But what do you think Powell's dot plot, his dot was in December? They don't tell you.
They don't tell you.
But what do you think his was?
I feel like he's fairly consensus.
Yeah.
I think especially you saw this over the past 6 months, in my opinion, he leads the Fed.
Yeah.
And I think you saw that with the 50 basis point cut. That was kind of unexpected by some people. Powell seemed to be pro that 50 basis point cut. Others seemed to be against it, and they ended up doing it. I think that showed the market, showed a lot of kind of commentators that Powell, at the end of the day, is the Fed. And in my view, the other participants have an opinion, and they'll go on, the media and talk about it. But I think if there is an opinion that Powell has that he holds strongly, he will make the other members comply.
Well, and we have a little bit of inside the game, call it, information, where one of our advisory board members, Bob Heller, used to be he was a board of governor. He was on the Federal Reserve, and that was under Volcker. And Volcker is about as strong of a personality as I think has ever been on the, running the Federal Reserve. But Bob Heller has always said, make no mistake, whoever the chairman is, it's his or hers Fed. Okay, they get input from the other players there, but it's his or hers Fed.
Yeah.
So I think that's true. So we'll see that tomorrow. I think one thing to keep in mind is their preferred inflation measure comes out on Friday. I'm sure they will know it by tomorrow.
Yeah.
It's the core PCED for December. And the guesstimates out there for the core are at 0.2% month over month. You annualize that, that's 2.4%. That's getting pretty close to the 2%.
Yeah.
So, all right, let's see what we got on the next one here. This is, this I think, not to beat the horses to dead here, but it is another way looking at the green line where you trim your mean inflation, take your highs and lows off of it. And you can see that's 2.2%.
Yeah.
I mean, just closer.
To give some background on what this chart looks at, because not a lot of people are familiar with this measure. The idea of inflation is that it tracks the basket of what you're buying,
right,
and sees what the price changes are over time. There's also a core basket of CPI or PC, and what that is X food and energy, which are traditionally seen as more volatile items. So they want to get, economists are trying to get the pure trend of what this basket of goods that people are buying is, and what's also the trend within that, excluding all the stuff that's moving around. Moving around a lot. The issue with that is it's not just food and energy that can be volatile. So what this measure is trying to do is isolating it to just the core trend, not just X food and energy.
Right.
So it's basically just cutting off the tails of the highest and lowest readings for that month. Okay, what's the underlying basket doing, the broader basket?
Yep.
And you can see that it's as a result, it's a much smoother line. That blue line is the year over year, and then kind of as a higher frequency data point, that green line is the 6 month annualized. So even over the past 6 months, you're at 2.2% inflation. That's basically at the 2% goal.
Yeah.
So this, I think, shows the underlying basket. Yes, it's slightly higher than what the Fed's looking for, but there's a lot of noise, and if you cut through the noise, you're almost there.
Yeah. And I think, the market, we had the 10-year that started the year here at 457.
Yep.
It then ran up to 480 on kind of this inflation scare that, are we going to have too much tariffs? Are we going to have this? Are we going to have that? It really felt more like an inflation scare that now the 10 years settled back down to where it started. And it feels more like, we're back looking at growth and the other things that really are going to drive the market.
Yeah.
All right. This, again, obviously, the labor market is one of two things that the Fed must focus on: full employment and inflation, trying to keep it down at the made up 2% number. But what do you see off this with these inflation numbers? That 6-month average at 165,000. Is that what we need on a monthly basis to kind of, maintain the 4+% unemployment rate?
Yeah, from what I've looked at, it's about in that range.
Okay.
150 to 200 is what you'd want to maintain full employment, given population growth.
Yep.
So we're right in that sweet spot. I think one of the things that this chart shows too is how much it's trended down over time, especially over the summer and kind of into the fall. You saw a few very weak prints out of payrolls, and that raised a lot of red flags for a lot of people, including the Fed. And more recently, you've seen strong back-to-back prints, and kind of other labor market indicators as well have been kind of eased off the brakes and seem to be stabilizing. It's only been a few months now, maybe 3 months, and it's hard to say definitively, but in our view, there's potentially some stabilization out there, as opposed to weakening that you saw during the summer.
Yeah. And for people out there, again, at a 4.2% unemployment rate in a historical trend is really, really low. All right. What do we got on the next one? Okay. This one I like that you put together. Not that I didn't like the other ones, but this shows in 1975, the government was almost 19.5% of all jobs. It's down to 14.7. Two things I'll make as an observation, then I want to hear your points there. Mm-hmm. People love to worry about, we just saw it in 24, they were scared to death about the outcome of the election and which administration would be running policy. We always like to say here, 85% of the economy is the private sector. That's a lot bigger number than 15 for the government. And somehow the private sector is really good. You give them the rules and they'll adapt to them really, really well. And so what this kind of shows over that 50-year period, you can see that local government has actually shrunk and federal government has shrunk, both of those by about 2.5 points. And then state has been kind of flat to up 50 bips. So again, I like seeing the curve move that way because I like private because they can be put out of business and they have to generate their own demand. So they get creative.
Yeah, I think the point of this chart is to really give you some historical background of what's been kind of a hot button issue recently. A lot of these jobs reports and I think broader just discussion, the president coming in about federal jobs, how much what's the government's role in the economy. And you can see that as, in terms of the labor market, the government has played a smaller and smaller role over the past 50 years. So I think it's been in this long-term downtrend. You've seen some ticking back up recently, but you can see if you look closely, you can see that ticking back up, but it's not a huge percent. Federal government only 1.9% of the labor force. Like that is not a large percentage at all. So it's kind of, you have to take a step back sometimes, see, okay, what are we actually arguing?
Yeah. And it's one of the reasons that I would argue for American exceptionalism is that the government, again, is less than 15%. Look at a lot of other developed OECD countries. It does not look like this. And there's not many people. If you guys know someone, please let me know. I don't know of anybody who thinks that our government is efficient. I don't know of anybody that thinks that our government is ramping up in productivity. So again, as you take more of it away from the government and move it to the private sector, you get an immediate boost. And I know one of the risks, and we'll talk about this later, is that uptick that you see from the last administration with adding to government jobs. You can see that uptick there. And if that were to kind of like get back on the trend line there, instead of having an expansionary force there, you would have somewhat of a contractionary. Mm-hmm. But again, I'm very bullish when you transfer it back to private. All right, let's see what we got next. Okay, this is your old adage here where we just had Scott Bessent. He is the new Secretary of Treasury. He was just confirmed. last night. Scott Bessent would say that it's not a revenue problem, it's an expense problem. And why would he say that? Because historically, the federal spending has been about 20% of GDP. That's up at about 23 to 24 right now. And the revenues have been 17%, which is right where it is. So that delta historically of 3 points, that's very manageable because the economy is growing.
Right.
And you can overcome that 3-point deficit.
Yeah.
But when you go to 6 points plus, you cannot.
It's a lot harder.
A lot harder to overcome. You would need massive productivity. So any other things when you look at this that you look and say,
I mean, I think it just speaks for itself.
Yeah.
You can see historically they've kind of moved in line in the past few years.
Yeah.
They have not. And also projected by CBO that will continue to increase that spread. So, at some point it'll need to be addressed.
Yeah.
Is the reality. When that happens is unclear. Hopefully sooner rather than later.
Yeah.
But that is, I think, again, it speaks for itself.
This is the first time that I can think since Obama's first term when he had the Simpson bulls that tried to go after saving, trying to cut the deficit.
Yep.
So we haven't had anything since that period. So at least this administration is talking about it, putting a committee together, putting DOGE together. Yep. I see now that DOGE, instead of living outside, is going to live inside the government. Mm-hmm. Whether that's good, bad, and different, I don't know, but they are trying to talk about it. All right, let's see the next one we got here. This is, I like to say, this is the mother's milk here, productivity. It's the one thing that is hugely deflationary. It's the one thing that really adds to the margins. Mm-hmm. And what I like looking at this picture here, you see two previous tops. Let's round them up. They're 4%, but they're separated by about 35 years, I think. 1965, you peaked at just over 4 for productivity. And then in 2000, 35 years later, you peaked at around 3.7, close enough to 4 for my work. And this one right now, we're at 2%, meaning that you may still have another 10 years for this thing to go from 2 to 4.
These are very, very long cycles, kind of matching technology cycles in broad terms. In 2000, you obviously had C and kind of this entry of the internet. In the 60s, you had the initial introduction of like mainframe computing.
1955, IBM starting the digital revolution.
Yeah, so these are very, very long sweeps of time. And this chart in particular looks at the 20-quarter average of productivity, which there's a lot of noise every quarter with productivity. We're trying to look at the broad trend. And if you just look at it, we're at 2% growth right now over the past 20 quarters. And I think our view is that will continue to march upwards.
Yep.
There's a lot of tailwinds that productivity has at its back. It has room to go as well. It's not like we're at some.
Exactly. No, that's, I think, is very interesting. All right. What do we have next here? I know we're getting close to the end here. All right. This is one thing that I focus on a lot. And the reason is 70% of the U.S. economy is the consumer. And the consumer, given real wages, the consumer will spend. Consumers like to spend when they're depressed. They like to spend when they're elated. They like to spend. But if they don't have real wages, it's very, very difficult. And you can see with this, we kind of kicked in with real wages back in May of 23 after a 2-year period of no real wages. Now, what kept the economy alive was transfer payments, which is not sustainable, whereas the real wages are. So what's sort of your forecast looking for the next 2 years on the real wages?
Yeah, I mean, I think our base case is that inflation continues to come down. And that's obviously one part of it. And then the other base case is that the labor market remains strong and wages keep up. So overall, they should continue to be positive, which, as you mentioned, drives consumer spending. If consumers' income exceeds what they're paying and how much prices are increasing, that's obviously good to their bottom line. That's part of our kind of base case for the economy. Why we think it's going to continue to march along is that consumers are doing just fine. They have income that's growing, even on a real inflation-adjusted basis. Yeah.
Love it. Okay. What do we have next? All right, this is one that I like looking at here. And it's for a lot of our listeners, you may not be super familiar with it, but I'll try to break it down here. The green line is looking at the forward 12-month PE. You can see back in 2000, it was 23 times. Today, it's 21.7. But back in 2000, the dark blue line is your operating margins, and they were around 6.5%, okay, versus 13.8 today. If you think about it, if you have a company that has a higher operating margin, you will always pay a higher valuation for that because you can earn back your investment in a shorter period of time. So if you make a ratio of that forward PE to the operating margin, back in 2000, it was about 3.5 times. Today, it's 1.6 times. The kind of simple average of this is 1.7. So we're actually below. We're below. So people get very fixated on just the PE, but you must look at what you're paying, what you're getting for that. Now, my question to you would be, is that 13.8 sustainable and can it go higher?
That's a question for sure. There's been a lot of speculation. I think this was more of a topic late teens, 2019. Are margins mean reverting? Are they going to come back down to that single digit number again? I think the past 7 years or so have kind of shown, not proved, but shown that that's not really the case, that margins aren't necessarily, they don't need to go back to some level, especially when you start to get, as we discussed earlier, productivity. You're able to get more out of every employee or out of every expense. That's why margins expand, is that you're able to get more out of what you're putting in. More for every dollar of revenues. Also, I'll mention the index itself of the S&P 500 looks a lot different than it did in 2000. Especially in even just looking at technology. These technology companies in 2000, almost none of them were profitable, or the large majority were unprofitable. So their margins were not very high. You've seen a lot of the advent of software companies, of these higher margin, just by the nature of what they are, higher margin industries that have become a larger part of the index. So as a result, the broader index looks higher margin as well. So you've kind of increased the quality of the companies you're owning over the past 20 years, just by the nature of time.
Well, and like you said, a lot of those companies back in 2000 were not profitable or very little. And that's because, as we going back to that previous comment we made, there were only 30 million people on the internet. Not a big pool to get money out of.
Exactly.
Where now you got 5 billion, and even if the pricing has collapsed. One other observation that I would make on this is Brian Moynihan, who is the CEO of Bank of America. Bank of America has 70 million depositors. They're a really good window on middle America. And his bank, the last 10 years, he's shed 30,000 jobs. So he has 213,000 team members right now. And the nominal expenses that he ran the bank on 10 years ago, it's the same number today. And he thinks in the next 10 years, he will add 0 to his headcount. He thinks the mix of the jobs that the 213,000 team members have will be different. Your margins are going higher when you're going to go forward 10 years with no headcount.
Exactly.
So, all right, what do we got on the next one here? I know we're kind of winding down here. Let's kind of go quickly through these so we don't take up too much people's time. But these are basically the earnings per share. You can kind of see the wiggles. Let's go through the next one here, which I know is similar there. I want to get to the last couple slides here. That's the yield curve. Let's go on to the next one there. All right. Give me a little background on this. For those of you that can't see this, this is talking about the dollar strength. Last year, the dollar, coming off of September, when the Fed really in earnest started doing their rate hiking, we watched yields go from 360 all the way up to 480, and we watched the dollar go from parity. We like looking at the Dixie, the DXY, went from parity up to 109, had like almost a 10% increase. What's the implications on that, and what's the forecast?
Yeah, I mean, I think this is, from what we've looked at, a result of everything that happened in Q4, which is stronger than expected growth. You had Trump election, you had the potential tariffs behind that impacted, or, that make the dollar stronger. There's plenty of kind of reasons why it went up so much in Q4. In terms of an outlook, I think if you just look at early on history, it is high relative to history. So that makes you think, with currencies, there is potentially some mean reversion there, which would be a tailwind to international equities. But it seems to be in this range where it's looked like it's going to weaken, it doesn't. It looks like it's going to weaken, it doesn't. So I think personally, I'm not super confident either way.
Yep.
I would just say probably maybe slightly weakened, but no huge conviction either way.
Yeah. And it's interesting. I know that the currency strategist at the beginning of this year basically had a forecast for a flat dollar. And you always have it bookended by individual people. Goldman Sachs is looking for the dollar to strengthen 5%. Morgan Stanley is looking for it to weaken 5%. I would say that Trump 1.0, the dollar peaked around about this time.
Mm-hmm.
And part of that is, as we know, Trump likes a solid dollar, but not a strong dollar. So my guess is Trump 2.0 will not be that dissimilar. So if I had to make a bar bet with someone, I think you're flat to down on the dollar, which has positive implications for international equity returns. Okay, I think we're coming, we have a few other slides here. This is your famous recession watch dashboard. We've got 9 different indicators that we look at. The only indicator that you have on there that is red, again, we keep it simple. We've got green is good, blue is neutral, red is cautionary. So the only one that you have is red is employment. What's the reasoning behind that?
Yeah, I mean, I think you saw that chart earlier on payrolls. It looks like there could be some weakness. There's some signs of stabilization. There are some risks still out there that we see.
Yep.
But I think on the positive side, it's only one of the 9 we really see a risk in going on on a look forward basis.
Yep.
And that is looking increasingly less likely. Yep. So on an absolute base, on an overall basis, it seems pretty strong. That could be turning to blue in the next couple months.
Interesting. This is a great one too for all of you listeners out there. We put it in our weekly slide pack, and it's a real good talking point. So you kind of have an idea of where we think we are in the economy. So either internally for your business or externally to your clients. All right. I think the last one is coming up here, which is our earnings estimate and then our price target. So I see on here that we've got a price target in rough numbers of 6,600 at the high end, and you got 5,800, 5,750 on the low end. And you're using that based on, it looks like kind of a no increase in the multiple, 21 times the out year at the end of next year. And again, like I said, I loved how your first year presidential cycle in a bull market kind of mapped out that 6,600. So kudos. Anything else you want to add to that?
I think you said it well. We don't see a lot of upside in the multiple. We are extended. We don't think it's going to revert down to 18. That is kind of the low end of our range, but kind of staying where we're at, given all of the tailwinds that we just discussed, I think is the reasonable base case.
Okay, perfect. So then just in quick summary, I would say our 3 risks that we're kind of looking at. I always like to tell people the black swan is what nobody's talking about. So when somebody tells you, what do you think the black swan is? I'm like, I have no idea. But when people are talking about it, it usually has been digested partially. Again, rates, they're break even on the 10-year year to date here, but it did go from 457 to 480 back to 457. The dollar's basically right where it started the year at 108. And then we have that expansionary fiscal side that could potentially be contractionary. But again, I think the productivity side will more than offset it. So James, thanks a lot for taking time to share your knowledge with everyone. And again, to the listeners out there, thank you for the partnership that you have. And we're always an open door and available. So let us know if we can help you and your clients out with anything. Thanks again.
Thank you.